Okay, so welcome everyone to BDO's webinar providing a UK tax update focused on professional services firms. So for the eagle-eyed of you, you'll probably note that I am not Anna Gerald. Unfortunately, Anna, our tax partner leading our professional services tax team in the UK, is unable to join today. I am Louis Keeping. I'm an associate director in the London professional services team. I've organised the webinar programme providing topical presentations with direct applicability to the PS sector since it began. Personally, I advise on a broad range of partnership structures for PS firms, particularly focusing on law firms, architects, consultants, and specialised in the sector for over 8 years now. I've got a portfolio of UK and international based PS clients and have extensive experience undertaking advisory, structuring work, partnership and partners tax compliance, as well as tax reserving matters. So for those of you who don't already know, BDO is a global accounting network with over $11 billion in revenue, providing auditing, accounting and tax services in 167 countries with over 97,000 staff. Our session today is to provide you with an update on UK taxes. Our speakers today are myself and Jitendra Patel. So Jitendra is a tax principal in BDO's professional services team. He specialises in corporate and partnership tax matters. He advises in a wide variety of business matters within the sector on both UK and international tax matters. Clients include legal, consulting, recruitment, architects, property advisors, and financial services, to name a few. A busy man, Jitendra, obviously. He also advises on partner and senior executive issues. Jitendra is qualified tax advisor, sits on the CIOT's owner-managed business technical committee, which really gives him a valuable insight and influence over developing areas of law and tax practice. Prior to joining BDO in 2014, Jitendra spent over 10 years at HMRC as an inspector of taxes there. So looking at what we're going to cover today, I'm going to look at Finance Act 2022, giving an overview of the PS firms, a spring statement update and future expectations, HMRC thematic reviews and what we're seeing, and then we'll finish with some questions. Please do ask questions during the webinar using the Q&A feature, which is at the top of your screen. We'll pick up on as many as we can at the end of the webinar, or if time does not permit, after the session itself. We're also recording the webinar and we'll email you the slide deck as well as a link to the recording in a few days. We will finish within the hour. So now I'll hand over to Jitendra.
Thank you, Louis, and thanks especially for those that warm introduction. And delighted to be talking to our audience today, and it looks like we've got a really good turnout. So absolutely delighted to be talking to you about this update. So as Louis said, I'm going to cover an overview of the Finance Act, which was enacted 2 months ago. I picked out 2 key areas of interest for professional service firms. Those 2 areas are basis period reform, which is going to be highly significant for partnerships, LLP businesses and their partners. Probably many of you will have heard about this already. We've been putting out a lot of articles and it's been quite heavy in the news, but we'll be going through it in a little bit more detail what it's going to mean. And the second topic I'm going to cover today is notification of uncertain tax treatment. This might be something that people have heard less about, but it's going to be critical for large corporate and partnership businesses to be aware of these new requirements. And I'll come on to that after I've talked about basis period reform. Can we go on to the next slide, please, Jade? And then if we skip one as well, I've covered that point. Okay, so talking about basis period reform then. So before I talk about the changes, I'm going to just give a brief overview of the current basis period rules, which many will be familiar with already. So sole traders and members of trading partnerships are currently taxed on profits that arise in their basis period for the tax year. So this is how they report their trading profits in their own personal tax returns under self-assessment. So as it stands at the moment, usually the partner's basis period will be the same as the business's accounting year end in the tax year. So for example, many of our LLP clients have a year ended 30th of April 2022, so ending tomorrow. That would fall into the 2022-23 tax year. So that's when partners are doing their tax returns for that year, they would include 12 months of profits for the year ended 30th of April 2022. So that's how it currently works for most partners. We have some special rules when an individual joins a partnership. These call the opening year rules, and also when a partner leaves a partnership as well, or the partnership ceases. And that's what we call the closing year rules. The way that those rules work, they're quite complicated, and they can lead to profits being taxed twice in the opening years, and we have a situation called overlap profits arising. I mean, you do get relief for those overlap profits, but not until a partner leaves a partnership or there's change of county date or something like that. So they're quite complex rules. The general principle is that profits should only be taxed once. You can have situations where sometimes you don't get the full relief for overlap profits, but generally the idea is every pound of profit should only be taxed once. But we do have these complicated opening and closing year rules in order to align a partner's basis periods with the business's own accounting year effectively. Next slide, please, Jade. Okay, so last summer, HMRC launched a consultation about reforming basis period rules. Initially they came out to people like myself as a member of the CIOT, and then launched a wider consultation as well. And the reasons that they gave for wanting to reform basis periods were to make transition to making tax digital for income tax easier. I'll talk a little bit about that perhaps later. But making tax digital, hopefully people have heard about this. It's now due to come in for income tax purposes in April 2024, and what they said was that they thought reforming basis periods would help the transition to making tax digital. They also said that the reform to basis periods would very much simplify tax admin for self-employed and partnerships. What they told us is actually many people just don't understand the basis period rules. They don't understand the overlap profit, all of those things. And probably we're talking at the smaller end. When we talk to our sort of large partnership clients, lots of people were saying, but we're familiar with those rules, we know how to deal with them. So it's debatable whether what they're suggesting and what they have now enacted is a simplification for our large professional partnership clients. There's very mixed views about that, but in terms of legislation, it does remove a lot of the legislation around basis periods and overlap. The third bullet point there, I've put with a question mark. So HMRC very explicitly told us that reforming basis periods wasn't about advancing tax payable on profits. However, we noted that as part of the policy measure, when they published how much extra tax they expected to bring in as a result of this, the figures were 1.7 billion over a period of 5 years. So even though they're telling us that's not the reason, we can see how the government was particularly attracted to actually trying to bring some of this extra tax in. And when I say extra tax, it's a timing issue, so it's an acceleration of tax rather than additional tax being payable. So when does the reform take effect? So 2023-24, so that's the next tax year, is what we call the transitional year, and I'll come on to explain what that means. One point to note is that initially when HMRC launched their consultation last summer, they were proposing the transitional year would be 2022-23, so effectively now. Now the overwhelming feedback going back to them was that's too soon, that's not enough time for businesses to be able to prepare for this huge change. So thankfully they did allow an extra year in order to allow preparation. I think what I would say to businesses that are going to be affected is do think about that extra year and use it wisely, because we campaigned quite hard to get that deferral. So it's important that actually people do spend the time and prepare accordingly. So next year is the transitional year, and then when we get into 24-25 tax year, that's going to be the full new system from that date. Next slide, please, Jade. Okay, so what is the change? So we're going to move from the current basis period rules to what we call the tax year basis. So what will happen is that profits that actually arise in the tax year, so we're talking about April to April, will be taxed rather than the profits of the accounting period ending in the tax year. Where businesses don't have an accounting year which matches the tax year, there's going to have to be some sort of apportionment between consecutive accounting periods in order to match the profits to the tax year. This is going to mean that profits are taxed sooner for all of those businesses that are not already using a 31st of March or 5th of April year end. But obviously, that need for apportionment is likely to mean that estimates are going to be required, particularly where you have an accounting date later in the tax year. And just a point there is, and I mentioned it briefly, is that 31st of March can be treated as equivalent to the tax year for this purpose. So that's quite helpful because at least people can use full months rather than having to do daily apportionment. Next slide, please, Jade. Okay, and I mentioned 23-24 as a transitional year. So what's going to happen in this year is that we're going to have a full basis period that would normally apply for that year being brought into charge. So if you've got a 30th of April year end, you would have your 12 months to 30th of April 23. But then also what we're going to have to do then is also bring in an additional amount of profit from the next accounting period. So in that situation with the 30th of April year end, we're going to have the period from 1st of May 23 to the 31st of March 24 brought into that year's tax charge as well. So effectively, we're having 23 months of profit being taxed in 2023-24. You will be able to have a full deduction for any overlap that's been brought forward. And a point to note as well is that if that overlap relief creates a loss, then this can be treated as a terminal loss and can be used against 3 prior years worth of trading profits. Again, that was an extra concession that HMRC allowed. Initially, they were just proposing the normal rules where you can carry back 1 year. And many people pointed out that there may be situations where that means some people can't use all of their overlap relief. So they did give that extra flexibility to go back 3 years. Next slide, please, Jay. Okay, so there's quite a lot of words on this slide, but it's a hypothetical example just to show you what the effect of the transition year is. So we've got a hypothetical professional services firm, XYZ LLP, with 40 members, has a 30th of April year end. Profits for the year to 30th of April 23 are 20 million. And in the year subsequently, so to 30th of April 24, the profits are expected to go up to 24 million. So the 20% growth in profits there, just for an example. Now, under current rules, as I mentioned, in 23-24, partners would normally have been taxed on their share of that 20 million profit. So that's from the year ended 30th of April 23. But under the transitional rules, we're going to have that same profit being taxed, but then we're also going to have another 11/12 of the following year's profit. So we're going to have 11/12 of 24 million from the period ending 30th of April 24. As I mentioned, partners will be able to claim overlap relief, but I will just show you on the next slide how that might translate into potentially additional tax being payable. Next slide, please, Jade. So just some numbers and a quick calculation just to put a bit of colour around the example there. So as I mentioned, profits for 30th of April 23 is 20 million. We've got our apportioned profits from the next accounting period, which is 22 million. So that gives us a total of 42 million. That's 23 months worth of profit. As an example, overlap relief is 5 million. Now you'll see that that's significantly less than the additional profit being brought into charge as a result of that transition. We think that's probably not uncommon. Obviously, this is hypothetical. However, it's common for overlap profit carried forward to be significantly less than we'd expect the transition period profit to be as a result of increasing profit profile. And that can be of the partner individually. So when they became a partner, may have been relatively junior and their profits have increased over time, but also as a result of increasing profitability of the firm itself as well. So once we do that calculation, we have taxable profit for 37 million for 23-24, and the approximate income tax and LIC on that is 17 million. Now compare that to what it would have been under the existing basic period rules, and that's about 9 million. So you can see there we've got an increase of 8 million tax becoming payable in that year. So that's an acceleration of tax on profits. So just to mention here as well that this is a hypothetical example. We've aggregated figures for the partners, but in terms of how this would actually play out, this would be per each individual partner's tax return. So their share of profits for each of those periods, their own overlap relief, and the effect of that would come out in their own self-assessment tax return. But partnerships as a whole will be wanting to think about this, particularly if they're reserving from their own finance perspective. So this is an example just to demonstrate what the effect is going to be. Next slide, please, Joe. Okay, so as I mentioned, HMRC, recognise that this is a big change for partnerships. So because of the acceleration of those profits being brought into tax, they are willing to provide some kind of concession, and the way they've enacted that in the legislation is by allowing spreading of that extra profit charge. So what will happen is that there'll be an automatic spreading unless there's an election made to do otherwise. That spreading will bring 20% of that additional profit for that transitional period, and that's net of the overlap relief, into charge in that first transitional year of 23-24 and the following 4 tax years. So we have 20% being brought in across 5 years. Now, what a partner can choose to do is they can elect not to spread if they want to, and they can opt out altogether, so they can pay all the tax in respect to 23-24, or they can pay different amounts, so they can bring in some extra in each of those years. They have to pay a minimum of 20% tax. It's 20% of the profit, I should say, but they can pay it sooner if they wish to. And the time limit for making that election is 1 year from the filing date for the relevant return, and that could be attractive if the tax rates increase. So the good thing about this is that there is time to reflect on whether the tax rates have increased, and then to make an election and maybe accelerate some of those profits into the period before the tax rates change, if partners want to do that. We're not necessarily expecting a tax rate increase, but you never know. And as I mentioned, this is on a partner by partner basis, so each individual has to make an election. However, it may be that firms, will want to have a consistent position, so they may expect their partners to either spread all their profits into 5 tax years, or make a decision that they don't want to do that. And that will generally be the case where partnerships are reserving, so they're managing the finances of the firm, so they may have a central steer on what they want partners to do. Now, if a partner leaves the partnership or retires, there'll be a cessation. A cessation will accelerate the remaining spreadable profits into the year of cessation. So if they've been spreading 20% and 20% in years 1 and 2, but leave in year 3, then all of that remaining profit that would otherwise be spread across years 3, 4, and 5 would be brought into charge in year 3. Next slide, please, Shane. And here's just a quick example of some hypothetical numbers just to show the effect of either spreading or not spreading. So firstly, we've got a calculation showing no spreading. So for instance, let's say the individual profits to 30th of April 23 are 200,000. Then we have a transition period profit up to 31st of March 24 of another 200,000. And then, as an example, the individual has overlap relief, they can claim the 50,000. So we end up with £350,000 of taxable profit in that tax year, as opposed to 200,000, which it would have been under the current basis period rules. Next slide, please, Shade. Now, this shows the effect of benefiting from the spreading. So instead of the whole of that extra profit being brought into charge, we only have 20%. So rather than 150,000 of extra profits, we have 30,000 being brought in there. So that means that we have chargeable profits in 23-24 of 230,000. And as I mentioned, that would carry on until 27-28 tax year, unless the partner chooses to pay tax on profit sooner, by electing to bring some of those profits into an earlier tax year, or if they leave, or there's a cessation of the partnership trade, for instance. Next slide, please, Shade. Okay, so once we get through the transitional year, the rules will take full effect from 24-25. So from that year onwards, all partners in partnerships and sole traders as well will calculate their taxable profits on a tax year basis, so 12 months aligning to the tax year. We'll never have overlap profits and relief arising again. And one thing to note is that as it stands at the moment, the partnership return period, so let's say our partnership has a 30th of April year end, just keep using that example, they will still file their partnership return based on that accounting period, but the partners' basis periods will be different. So we're going to have that mismatch between the partnership returns and the partners' profits being reporting on their self-assessment tax returns. Next slide, please, Joe. Okay, so that leads me to talk about some pending matters with HMRC. What we're seeing is that there are a number of partnerships and who currently are using a non-tax year end accounting date, but are likely to change to match the tax year. So they're likely to move to 31st of March because they've looked at this and thought it's going to make our lives easier if we have a tax year accounting period for the partnership, so that those profit shares can be automatically put onto the partner's tax return, and there's no need for any apportionment. However, HMRC recognise that not every partnership is going to want to or be able to change their accounting date, and there's lots of reasons for that. And we think large partnerships are most likely to be affected by this, particularly international partnerships. Now, that can be driven by accounting dates in other countries, particularly 31st December comes up as a date many businesses will use because it matches the tax year in many other jurisdictions. But there may be other reasons as well, and sometimes it may just be size and various other things, reasons why it's very difficult to change the accounting date. So HMRC recognise that those businesses are going to have significant administrative burdens as a result of these changes, because particularly where the accounting date is late in the tax year, it's going to be difficult to have an accurate picture of a partner's profit share up to the end of the tax year. Okay, so HMRC are currently consulting on some options for some administrative or policy easements they may be able to introduce. It's something that they promised to do earlier in the year, and they have been talking to us recently and have published some information as well. So they've got 4 options on the table. I'll just talk through those briefly. So the first one is just to keep the current rules as they are. So it's what we call the do nothing approach. Now, current rules are that the tax return for the partner should be filed using estimated figures. And the HMRC guidance says that as soon as final figures become available, that partner should submit an amended return. So that's our option 1 of doing nothing. Now, option 2, which HMRC think is a little bit different, is to say, okay, you still need to file with estimated figures and you're still going to have to file an amendment, but you can do that when the next tax return becomes due. So you don't have to do it as soon as the final figures become available. You can do it when the next tax return has to be filed. So the idea is that you've got just one cycle. You don't have to do an interim amendment for the previous year and then as cycle bring in your next tax year return submission in place. Now, in practice, we don't think that's that different to what businesses are doing anyway, and typically we see amendments to correct estimates being filed at the same time as the next year's tax return anyway. So we're not sure that's much of an easement on what they've got at the moment. So the third option they've proposed is to extend filing deadlines for certain affected businesses, and they have said this will be a very narrow extension, and they want to consider how long those filing deadlines can be extended by, and which businesses in particular they would do that for. But it's, the idea behind this is that if a partnership has longer to provide partners with their profit share figures, then and for them to report those in their tax returns, then it's more likely that those will be accurate, and that means an amendment what needed to be filed. So that's the idea behind that. And then we've got our fourth option, which is to use estimated figures and then true up in the following return. So that means no amendment would be required to the tax return that use the estimated figures, but there'd be some sort of balancing adjustment made in the following year's tax return. Now that's something as well that initially it sounds quite attractive because it means you don't have to go back and amend. However, there's bound to be some complexity in that because there's a situation where those tax figures and profit figures are never going to be 100% accurate because they'll always be subject to adjustments from prior year and current year, effectively. Now, we are discussing with HMRC these options at the moment. We've released a survey, which some of you hopefully have completed already, but we'd very much like to get your views on which of these options you prefer, so we can feed that back to HMRC. And I believe that's just been posted into our chat on this as well, so hopefully you can click on that, and perhaps after the webinar, if you can give us your views, that'd be really helpful. Okay, Jay, can we move on to the next slide, please? Okay, so this is a slide just with some suggestions as to what businesses should be considering with regards to basis period reform. I want to talk through all of those, but a big thing for partnership businesses is going to be the effect on cash flow. So it's important to model the tax payment profile and cash flow impact of the change, particularly for those partnerships that are reserving for tax and using those funds for their working capital. That's going to have a big impact. But also at the partner level, even if there's no reserving, the partners will need to know that they're going to have to pay tax sooner than they might have been expecting, so they can actually plan their affairs accordingly as well. So that's definitely something businesses need to think about. The obvious one as well is, and when we're talking to clients, many people have asked, should we change our accounting date now to the 31st of March to make it life easy going forward? So it's something definitely that firm should be thinking about. And also, when do they do that? That's another point as well. So should you do it in 21, 22? So that's the year just finished, or either 22, 23, or 23, 24. I've mentioned considering the impact of the health and social care levy. Now, Louis will probably mention this, but we've got an extra 1.25% of national insurance, effectively, being charged from April 2022 onwards. There is a possibility of accelerating some profits into the 21-22 tax year by changing accounting dates, which would mean that some of those profits would then not be taxed to the 1.25% extra charge. But it's something that businesses will need to think about carefully, because obviously we're already past 31st of March, so it can be quite difficult to process such a significant change. So something to think about and be aware of, but certainly definitely think worth thinking about whether you should change and when. And the other thing to think about is managing the communication as well to the partners. So that's definitely something that's going to be quite important, so that they're aware of what's happening as well. So I won't talk about all of those in detail right now, but there's a list there of things that people should be thinking about. Okay, next slide, please, Shade. Okay, so this leads me on to my next topic now. So the other key area for professional services firms that came out in the Finance Act is this requirement to notify HMRC of uncertain tax treatment. So this is going to affect large corporate and partnership businesses, and they will be required to make this notification subject to conditions being met, which I'll talk through. The idea around this is to encourage large businesses to discuss areas of tax uncertainty with HMRC in real time before filing their tax returns. And the reason they want to do this is to reduce what they call the legal interpretation tax gap. Now, that's different to what we call tax evasion, tax avoidance. So tax evasion, deliberately, avoiding declaring profits and such, or falsifying expenses. We don't see our clients, getting involved in that kind of thing. And similarly, avoidance schemes as well, generally not. So what HMRC regards as avoidance schemes are generally businesses or high net worth individuals trying to exploit loopholes with rather artificial arrangements. This is different. This is a legal interpretation. It's where there are genuine grey areas in the law, and there can be different views taken. And very experienced technical people can look at those and still come up with different answers. So it's around trying to reduce that tax gap between HMRC and what gets reported by businesses under that lead differences in legal interpretation. It applies to relevant returns due to be filed on or after 1st of April 2022. So that potentially applies to transactions that have already happened. So that's really interesting. Next slide, please, Shade. Okay, so on this slide, I'm just going to talk through the scope of businesses that are in the potential requirement to notify. So a company or a partnership is qualifying in any financial year if in the previous financial year it had either or both of UK turnover of more than 200 million or a UK balance sheet total of more than 2 billion. And just a quick comment on what we mean by UK turnover. So if we have a UK resident company or a partnership, that UK turnover includes all of the turnover, and the same with the balance sheet. If we have a non-resident company or partnership, then that UK turnover or balance sheet reference only applies to turnover and balance sheet attributable to permanent establishments in the UK. Now, for companies in the same group, and that's a 51% group, that turnover and balance sheet threshold is aggregated. So you look across the group. But an interesting point is that there's no aggregation for partnerships, and they're considered on a standalone entity basis. So if you've got a partnership with corporate subsidiaries, for example, you don't aggregate the results of the corporate subsidiary with the partnership. Next slide, please, Shay. So relevant taxes and returns, we've got corporation tax and a company tax return, income and corporation tax and a partnership tax return. We've also got PAYE returns, VAT returns. So we're looking at all heads of tax within this. And the notification requirement applies separately in relation to each relevant tax. Next slide, please, Shay. Okay, so an uncertain tax treatment is what HMRC refer to as an uncertain amount being included in that return. Now, what is an uncertain amount? Now, this is defined in the legislation. It's based on two triggers, and one or both of those may apply. The first one is an accounts provision. So this is where a provision has actually been recognised in the accounts of the company or partnership to reflect the probability that a different tax treatment will be applied to a transaction to which the amount relates. So effectively, if the accounts show that there's an uncertainty in terms of position that's been adopted in respect of tax, then that meets that trigger, and is subject to the scope that I just talked about, and also some exemptions which I'll come on to. That means that the business would need to notify HMRC. The second trigger, which is probably more difficult, is HMRC's known position. Now, in a partnership context, we probably see this one being more likely to apply than accounts provisions, because particularly in respect of direct taxes, we generally don't see provisions in respect and being made in the partnership accounts. Now, HMRC's known position is where the tax treatment applied in arriving at the amount relies wholly or in part on an interpretation of the law that is not in accordance with the way in which it's known that HMRC would interpret or apply the law. So they're effectively saying, if you take a position that is different to what we think it is, and that's something that the business should be aware of, then they need to notify. So known means contained in HMRC published guidance, statements, or other material, or from dealings by or in relation to the taxpayer with HMRC. So effectively, if a business has already had some correspondence with HMRC on a particular point, and they've got a view from HMRC, if the business then takes a different view, then HMRC wants them to notify. So direct correspondence with HMRC on a particular point between the business and HMRC, and that's quite an interesting point as well. So it's that particular business. It doesn't. If a business is aware, from someone, they may know that they've had dealings with HMRC and received the view on something. that doesn't apply. It's only if that business has directly had a view from HMRC. However, it does cover all of the things that are in HMRC's published guidance or statements, so everything that's available in the public domain. If there's anything that's known in those publications as HMRC's view on a matter, if a business wants to take a different contrasting view, then they're required to notify HMRC. Next slide, please, Shade. So as I mentioned, so there's the two triggers to consider. There's the threshold as well, so in terms of size of the business, and then the other thing to consider is whether there's an exemption there. So there's in terms of the threshold, we've got our scope. So that's the size of the business that we need to think about. We've also got the value of the tax advantage to consider as well. So if the value of the tax advantage from that uncertain amount exceeds 5 million, then you're in. If it's below 5 million, so even if you are within scope, even if you're taking a position that's against HMRC's known position, if the tax at stake is, let's say, it's only £1 million, then there's no requirement to notify there. And on top of that, there's also a general exemption as well, and then a specific exemption. So if HMRC already have all the information available to them, so it's the same information that you would make if you had to notify effectively, then there's no requirement to meet this statutory requirement to notify. The idea is that you've already notified HMRC already, so you don't need to notify them again. And then there's a very specific exemption as well for intra-group transactions, and that's where if you're looking at the group as a whole in relation to a particular position that's been adopted, if the net tax advantage doesn't exceed 5 million, that's also out. Next slide, please, Jane. Okay, so the deadline for making notification. So for company tax returns, it's the later of the tax return deadline or the account filing deadline. A partnership tax return is the tax return deadline. The PAYE and VAT deadline is slightly different. It's the date the last PAYE or VAT return for the financial year is due. And there's also penalties chargeable as well. And these can get quite heavy depending on the level of failures. So 5,000 for the first failure in respect of a relevant tax. And the point there is to say it's in respect of relevant tax. So if there's failures across the multiple heads of tax, then those can multiply. There's 25,000 for a second failure, and then you can get up to 50,000 for subsequent failures. But when we talk to HMRC about this, what they're saying is we don't want to charge penalties. Actually, what we want to do is just, for businesses to come and talk to us if they have an uncertain position, something they're not sure about, or they want to take a position that's different to what HMRC thinks. They want the business to come and talk to them about it. So they're not looking to charge penalties effectively. They just want to get HMRC the business to come and talk to HMRC. Next slide, please, Shay. Okay, so there's a few areas of difficulty with compliance with this legislation that I just wanted to talk about briefly. First one is just around this point around awareness of HMRC's known position, and it can be difficult, for a business to know, everything that is in HMRC's published guidance, and it may be, taking a position on something that they don't necessarily appreciate is against HMRC's view. So it's definitely a need to take advice on those matters. It's interesting to note as well, we talked to HMRC about situations where their guidance is, we would think is incorrect, advisors would think it's incorrect, businesses would think it's incorrect, and that might be where they've got a point in their guidance which has been taken to tribunal or court, and actually HMRC have lost, for example, but their guidance hasn't been changed, to reflect that finding of the tribunal or the court. Now, HMRC's view on this is you should still disclose, because it's, if you're taking a position, even if it's in line with the tribunal decision in a separate case, you still need to disclose, because it's contrary to HMRC's guidance. And they say this is because sometimes it will be HMRC don't necessarily agree with the decision, and it may be subject to appeal, so it's not final yet. But actually, what they've generally said is, they want businesses to come and talk to them. Okay. Another thing is we picked up some particular challenges for partnership as well, and there's a number of grey areas in the legislation with respect to partnerships. It refers to a tax advantage to a partnership. We pointed out that a partnership itself doesn't pay tax on its profits directly, and the partners do. So the wording of the legislation perhaps leaves it a little grey as to whether it applies to tax payable by partners at all. We think it does when you look at the legislation in the round. However, it's unfortunate that the legislation leaves some of these grey areas. We see a similar grey area with PAYE advantages as well, because even though a partnership has the obligation to deduct tax under PAYE, it's not a liability of the partnership. Sorry, it's not a tax of the partnership itself, it's tax of the employees. Another thing as well is it's unclear to some extent in the legislation whether when we're talking about uncertain amounts, it only refers to in a partnership context the computation of profits effectively, so an uncertain amount determining how much profit there is of the partnership. But there could also be uncertainties around how those profits, once they are computed, are allocated between the partners. And a classic example is application of the mixed membership rules, where there can be uncertainties around whether those rules apply or not. For those not that familiar, you can end up with a reallocation under these rules from a corporate member to individual members. But there's lots of cases where there'll be clearly different views between HMRC and the taxpayer on that. But we're not sure what the right answer is on that at the moment. We're consulting with HMRC to get some clarification. Okay, that brings me to the end of my section. So that's the key areas from Finance Act 2022. I'm going to hand over to Louis now, who's going to give a bit of an update from the spring statement.
Thanks, Jitendra. Really interesting. We've got lots of questions from the floor come in, so we'll pick those up at the end of the session, time permitting. So I just effectively wanted to kick off with a brief update on the spring statement. Took place on 23rd of March. Didn't really pack any surprises or unexpected announcements. I think the Chancellor set out his intention to cut taxes, albeit that's going to be at some point in the future, alongside immediate measures which are targeted at lower income taxpayers in a bid to kind of assist with the rising cost of living, which of course is going to be a difficult juggling act. I think prior to the start of the new tax year, firms have already been preparing for the impact of the 1.25% increase in health and social care levy, as well as the increased tax on dividends. I think many of our firms have been recalculating their tax reserve rates for the anticipated changes already. In addition, the impact of the basis period reform Jitendra discussed at length, and the scheduled increase in corporation tax from 19% to 25% from 2023 to 24 has also been considered. So I think while measures announced to increase individual NIC thresholds from July 2022 and reduce the basic rate of income tax from April 2024 will marginally reduce taxes, I think most businesses will find they'll go little way to kind of offset against the previous announced rises. The government's tax plan announced in the spring statement sets out 3 priorities: to assist taxpayers immediately with the rising cost of living, an intention to reform and cut business taxes, and a desire to redistribute proceeds of higher growth equitably. The government's also stated its desire through this plan to make the tax system simpler, fairer and efficient. We've seen the Office of Tax Simplification look at this in some detail. Initially, this seems to be focused on reforming tax reliefs and allowances, including removing some potentially. I think previous concerns that HMRC might look at changes to the pension tax relief system haven't yet come to fruition, but this could yet be an area that's kind of prime for reform in the future. The Chancellor's kind of made clear his commitment to strengthening the economy, but boosting investment to ensure that the UK remains a competitive place to do business. As we know, corporate businesses may be able to benefit from the scheduled refinements to R&D reliefs, capital allowances super deduction, which gives 130% relief for qualifying expenditure by qualifying companies, ends in April 2023. And I think without it, the government recognises that the UK's business investment incentives kind of lags behind other comparative countries. The Chancellor's announced that the government's going to look to implement reforms to tax reliefs on business capital expenditure for 2023-24 onwards. And in the meantime, the annual investment allowance, which can also be claimed on qualifying businesses, will remain at 1 million until 31st of March 2023. The government's going to increase funding to HMRC, which enables them to tackle complex tax risk areas, which obviously Tench was covered in part as well, with a desire to ensure a greater focus on enabling large and medium-sized businesses to pay appropriate taxes. Interestingly, across all taxpayer types, we've been seeing a reduction in formal inquiries raised by HMRC. I think the trend instead seems to be introducing measures which puts more onus on the business to encourage engagement with HMRC on areas of tax risk, i.e. the requirement for large businesses to notify uncertain tax treatments that Chandra discussed earlier. And HMRC is also looking to undertake sector-specific reviews focused on cohorts of taxpayers, such as HMRC's recent thematic reviews, which focused on the largest partnership businesses, which I will discuss on the next slide, please, Jade. So HMRC thematic reviews focused on the largest partnership businesses, generally those with CCMs at HMRC. But whilst focusing on the largest partnerships, it's of course important that all partnerships file on the correct basis, and it may well be that these reviews filter down to smaller partnerships in the future. So the areas we've seen thematic reviews include international partnership reporting arrangements. So many partnerships with a connected legal entity overseas have historically been permitted by HMRC to report the profits of such entities as if they were profits of an overseas branch of the partnership and include them in the UK partnership return. So whilst this admin simplification has been accepted by HMRC in the past when businesses were profitable, HMRC is now challenging such arrangements where the overseas entity is loss-making. I think it's concerned about allowing loss relief where there's no statutory basis for giving it for the losses of an overseas company. So if your partnership is using the so-called branch concession to report profits of overseas entities, it's important to review your reporting arrangements to identify if loss relief has been effectively obtained in the past and how future reporting will be organised. Next, we've seen tax records for partners' costs reviewed. HMRC is increasingly challenging partnership tax returns where the partnerships bought services for partners and claimed deductions in the partnership tax return. For example, where external accountancy costs for a partnership include the cost of preparing the partner's personal tax returns, HMRC will often challenge long agreed apportionment arrangements of combined fees and suggest a greater disallowance of partners' individuals' costs based on a more sophisticated analysis of the actual work carried out and related costs. Moving on to business asset disposal relief that replaced entrepreneurs relief in April 2020, HMRC is now carrying out checks to ensure that partnerships are recording and applying it correctly when partners leave, and in particular to ensure the relief is not applied where the 2-year ownership requirement has not been fulfilled. Finally, but not on the slide, just a reminder that HMRC have looked at partner round sum allowances, which becomes effective from 2018-2019, where some firms historically paid partners a relatively modest annual round sum allowance to reimburse them for small ad hoc expenses, the type that would usually meet the wholly and exclusively test for deductibility when looking at your tax computation. So in essence, again, this was an admin easement, saving the need to collate, kind of process and retain lots of small invoices. Many of the firms agreed this with HMRC a long time ago, a decade or more ago, in some cases, and the evidence of these agreements has been sometimes lost, in other cases not documented. So HMRC effectively changed their view, and the purpose of the new approach is really to address HMRC's perception that there's inconsistencies across the business services sector regarding the amounts of the round sum allowance paid, how the system is operated by firms, and tax treatment's been adopted. So in addition to the normal requirements for deductibility, i.e. the wholly and exclusively test, from 2018-19 onwards, HMRC will only accept that tax deduction is available for expenses incurred on a round sum allowance where the expenses are supported by records that have been kind of kept, such as receipts, tickets in the case of business travels. The only exception for this is the element of round sum allowances that's intended to cover for the use of the home as an office. So in this instance, flat rate amounts can be treated as allowable deductions in accordance with the expenses guidelines as published by HMRC. So finally, whilst not part of the thematic review, I just wanted to cover the composite tax payments that some partnerships use where they make a single payment on behalf of their partners for their income tax liabilities, accompanied by a spreadsheet, which HMRC then allocate amongst all partners' individual UTRs. Correspondence has been recently sent out in the past week or so saying that HMRC are going to be changing the way that composite payments are received and processed. There's going to be changes required to ensure you can still effectively use the process, but the main change is that the composite spreadsheet to be used will change, and instead there'll be standard forms for everyone. You must only use this the new format, otherwise your payment will not be processed anymore. You'll be issued with a new payment reference number that must be quoted when you're making a payment and on your spreadsheet when uploading this. They're also going to change the way you send the information to HMRC. So previously we would send it to send the spreadsheet to a dedicated mailbox. However, this change means it will now be uploaded via HMRC Secure Data Exchange Service, the SDS portal. So important when considering making these composite payments going forward, because otherwise, if you do it in the old format, they won't be allocated correctly amongst the partners. And we know how much of an admin difficulty this can cause when trying to rectify payments that are unallocated with HMRC. So that was a quick canter through a couple of points on thematic reviews and the spring statement. I'm conscious that we've had quite a few questions come in, so I wanted to spend the last bit of time just talking through those at the moment. So majority of questions came in on the basis period reform, Jitendra, so luckily I think quite a few for you here. So firstly, will the loss arising as a result of overlap relief in the transitional year be restricted in any way when carried back in the previous 3 years?
Yeah, no, it's effectively it's treated in the same way as a terminal loss. So if a partner left a partnership and there's a loss in the final period, and they can carry that back for 3 years against previous trading profits of those years. So that should be fine to use. There shouldn't be any restrictions on that, as long as there's enough profit in those previous years to use up the overlap relief that creates a loss. Then it should be possible to use those. We did see some issues where originally there was only meant to be a 1 year carryback ability under the normal rules, and we did think of circumstances where actually that might have caused some difficulties with being able to fully benefit from that overlap relief. However, with that extension to 3 years, we'd hope most people would be able to utilise that in full.
Excellent. And if the overlap relief creates a loss in the transitional year, is it possible for individuals to offset that loss against other forms of partnership profits they've got in the transitional year?
So it's treated in the same way as a trading loss, effectively. So in the way that you would use a trading loss against prior period trading profits and things, you can use in different ways as well, but you're then reliant on sideways loss relief rules in order to utilise trading losses in other ways.
Fine. So essentially, yes, you should be able to offset it against your other partnership profits in the year. One that we don't know has been looked at in detail yet, or conversations with HMRC, but how do you expect the process of electing to spread on a basis other than over 5 years to work if a partner's filing on a non-resident composite return? Have you seen any conversations around this?
It's a really good question, actually. Yeah, it's something that we had thought about. I think we're having discussions with HMRC. We've got another meeting with them next month as well, so it's definitely a point we can raise. My expectation is it's probably because it's all done on a sort of composite basis. It would seem practically probably the easiest if there's a consistent position can be taken across the partners. But as I mentioned, it's the elections are strictly on a partner by partner basis. Yeah. So it'd be interesting to know what the situation would be if there was a difference in opinion between partners all covered by a composite return. But generally, I think we'd probably expect that to be centrally managed by the partnership. So you'd expect there to be some sort of decision about whether to spread or benefit from the spreading, or whether to accelerate, and made on a consistent basis. So we'd expect there to be a mechanism to be able to do that within the composite returns. But it's certainly a good question, something that we'll talk to HMRC about.
Yeah, we've certainly had lots of conversations with our clients and contacts very much around some partners may want to spread, some partners may not want to spread. do we implement as a firm a consistent approach? And it's certainly been a difficult area for firms having these conversations.
Absolutely.
Another point, a good question actually, is assuming that making amendments is required if partnership profits are unknown each year on the individual tax returns. Is that going to then extend the inquiry window that HMRC can look to raise an inquiry? It seems if it's a forced amendment, it might seem a little harsh.
Yeah, we did talk to HMRC about that particular point because obviously when you file an amendment, HMRC then has another effectively 12 months from the court date in which that amendment is filed to raise an inquiry. Now, their view on this was actually that because the way that HMRC's practice is in respect of inquiring into amended returns is they can only inquire into the element of that return that has been amended. So everything else that has already was filed on time and hasn't been changed is all final, and they can only amend. So under the extended inquiry period, they can only inquire into the part that's amended. So their view on this is, if the only part that's been amended is the bringing in the extra bit of partnership profit, they don't really see that as any disadvantage on the current status, because actually that profit would have been brought in the later period anyway. So they don't see it as particularly an extension of an inquiry window. So that's their view on it effectively. So they're not looking to do any kind of easement around the normal inquiry window rules. Interesting.
There's other questions that we've got that I'm just conscious of time that we'll probably won't get to now. So we'll pick those up following this webinar, and we'll get in touch directly with those questions we've not yet covered. But I think that's kind of brings us to the end of the webinar for this session. Thank you, Jitendra, for your section. Very much lots of questions arisen out of that one, so interesting and topical as always. We will circulate the slides and recording of this webinar in due course. Our next webinar will be in June, covering an employment and global employment solutions session. So hopefully you can join us there, and thank you very much for joining us today.
Thank you, everyone. And just a final plea to complete our basis period survey. We'd definitely like to have your feedback so we can talk to HMRC about that.